Good morning, everybody. It works, thank you. Welcome to the Crane Seminar on Business Interruption. Breakfast will be served here in a couple of minutes, and please feel free to eat during the presentation because we only have about an hour and a half, so we're trying to get food and the presentation all in. For those of you that don't know me, my name's Don Hennon, and I'm the manager of the Risk Management Department at Crane, which encompasses claims, which is me and Molly's outside somewhere. We also have 3 loss control guys that basically do your loss control for you. We have Mike Schran, Joe Kleinschmidt, and Jake Crenshaw. And I think at least a lot of you worked with them in the past. So today's seminar is on business interruption, and the idea is to just make sure you have insight on when you have a large loss. The smaller losses are a little easier to deal with, but when you have a large loss, it gets to be complicated, and you need just to be aware of what and how business interruption works within your policy. Really, BI does not really come up all that often, but when it does, they're usually big, bad, and stressful. They usually are settled really between your accountant and the insurance company accountants. The adjusters really are just sort of a middleman there. So really that's how it gets resolved with exchange of information. So today we're going to have some topics within your policy that are terms really that you need to be aware of. Extra expenses, period of restoration, co-insurance, and holding periods. We've also made a business interruption worksheet that we sent out to you guys yesterday. And I'd really encourage you to get with your accountants and go through that line by line. It's a simple worksheet, but it really gives you some information that's really important for you to have it in your brain in case you have a major loss. When you have a major loss, there's so many things that distract you to get your business back up and running. So at least if you have that in place, you at least know that you have the business interruption coverage and the volume and the limits are there for you. So I can give you an example of really a catastrophic loss. You guys have all probably heard of it, being from St. Louis. 2 weeks ago, I was in my office and I got a call from the broker asking me to go out on a fire loss. We insure Lloyd Lang Box Company. Have you guys heard the explosion down in Soulard? I'm sure everybody here has. Mary Ann has not heard that one yet, probably. I think it was on national news, though. But really what happens is 7:45 in the morning, broker calls me. He says, Don, can you go out on the fire lawsuit thing? I go, sure. So we go down to Soulard, and it's chaos. There's fire departments everywhere, fire trucks, ambulances, news crews, helicopters, anything you can think of. And they've got it all blocked off. So we really can't even meet our insured. Their building's been basically destroyed through this explosion. So we finally meet our insured about 9 or 9:30, and it's just a terrible situation. He was just distraught. They had one family member get killed in the accident. So if those of you haven't heard about the accident, we think the boiler exploded, but really what happened was the water storage tank shot out of the roof of this building, was in the air for 11 seconds, shot down the street 500 feet, and landed on another office building, killing 3 people there. So we have four fatalities, we got multiple injuries, and the insured looked distraught. So what I'm saying to you is it really helps you to know you have coverage in place to get through situations like this. The fire department's there, they're interviewing him. The bomb and arson squad's there, they're interviewing him. OSHA's there, the police. There's multiple people interviewing this insured, and they all want to have an inspection at their building within the next week or so. To schedule that is a nightmare just to get that all orchestrated. You can't touch any of the evidence. They can't even get their business back up and running because the building is condemned. That's the first layer of inspections. Then you have the insurance company, the property insurance company. They want to have their expert go in there and figure out what happened. You got a work comp company that wants to go in there and figure out what happened. You got general liability companies that want to go in there and figure out what's happening. Then you've got the families that all have hired attorneys. So all these inspections have to be done before you can really do anything really with your building. So today we have a guest speaker to talk about all of that. It's Mary Ann Mull from Liberty Mutual. I really appreciate her coming in. She's traveled a long distance from Orange, California. It's very early in the morning for her, so give her a little slack there. Mary Ann's the manager of the Loss Services Audit Division, is that correct? For Liberty Mutual, and she's been an auditor for Liberty for about 30 years, so she really knows her stuff. So please join me in welcoming Mary Ann Mull.
Thank you. Can you hear me? Okay, I guess I'm holding it close enough then. I'm going to talk to you today about business income, and we're going to get into an extra expense. Just if we have a little extra time, I'm going to primarily talk about business income, but I can just reiterate what Don just said about an insured being devastated. Last year on the 4th of July, I'll just tell you a quick story. I had what I thought was a wonderful day. Late in the evening, got this weird phone call, and I thought, that's some person calling me. I'm not going to pay any attention. 4 o'clock in the morning, another phone call, something about a fire. So I thought, well, I better get up and go see, because my husband and I own a commercial building, and they said something about a fire, and I thought, oh, I better just go see. And I understand the devastation. I went over there to see a commercial building where the whole middle section, which was about 7 units, burned. The roof collapsed. And only to find out later, somebody was putting off fireworks, which landed on the roof and destroyed the building. So the same thing. You first of all have all of your public adjusters there who are wanting you to sign with them for emergency services, and then you've got all the crews there, the fire department, the police, the arson people, and it just goes on and on and on. So that whole part is devastating to start. You usually have a good understanding of your building and personal property, but it's the business income that you sometimes don't understand until you have to use it. You don't know what's available to you. So as Don said, I am with Liberty Mutual Insurance. I'm a CPA, also have my CPCU. I do manage our loss audit services department, and what that is, it's a group of CPAs across the country that what we deal with primarily is calculating and measuring business income losses for our insureds when they do have one of these devastating accidents. I also have been with Liberty Mutual for 32 years, so you can kind of get the idea. It's probably time for me to start thinking about hanging it up, right? Some of the topics we're going to discuss today is we're going to talk about some of the coverage forms. Many times when you purchase a policy, you know you have business income, but you don't really know what that coverage form says until you have to use it. I'm going to also talk about business income and how that form ties into your calculation when you do incur one of those losses. That, along with, in talking about the coverage, determine do you have sufficient coverage on your policy in the unfortunate event that you do have a loss. You do have some kind of disaster or event that occurs. And then at the end, as I said, if I have time, I'm going to talk a little bit about extra expenses versus normal continuing expenses. First of all, there's 3 requirements for you to have a business income loss. First of all, you have to have a covered cause of loss. So on your causes of loss form on your policy, it has to be something that's included as a covered cause of loss and not excluded. And along with that, you have to have an interruption of your business operations, and that interruption of your business operations has to cause you a loss of income. And not all times do you have all 3. You can have a covered cause of loss, you can have an interruption of your business, but depending on the nature of your business, especially if you're a wholesaler or a distributor or something like that, if you're closed for a short period of time, when you reopen, many times you can make up for all those orders that were to be shipped or sold during that time. And nowadays, when you have call forwarding and all kinds of available options for your phones, cell phones, whatever, you sometimes do not result in a loss of income. So you may have the covered cause of loss. Your business may have been closed for a portion or completely closed, or for a portion of the time you were partially open, but you may not have a loss of business income. And the way the loss of business income would be measured would be using your own financial records, your own data, your own history, your own trending to see what should have transpired during that time and what did not happen. But as I said, perhaps right afterwards you were able to make it up. On most of the policies that you have, whether written with Liberty Mutual or other carriers, we use ISO forms, which are going to be, they're the primary coverage forms, a CP 0030 and a BP 0003. So when you're looking at your policy decks, these are some forms you might want to look for to see if you have them, and that would be your business interruption coverage. It would detail how you are covered for that business income loss, and your deck page would tell you if there is a limit, what those requirements are for that limit of insurance. So these are the two forms I'm going to deal with today. I'm going to go through some definitions. I'm going to talk about some of the different coverages, how you can change those coverages. So again, when you look at your policy, when you go home or when you discuss it with your agent or broker, you can determine if you have the right coverage for the nature of your business. On the commercial property policy, which I'll talk about first, there's really two forms, a CP0030 and a CP0032, and I didn't mention a 32. The CP0030 is business income and extra expense. It gives you the option of extra expense. On the BP0032, it's business income without extra expense. And there still can be some extra expense, but there's a lot of more limitations to it on the CP0030. But the definition of business income is it's your loss of net income, which is your net profit or loss before income taxes that would have been earned or incurred, and continuing normal operating expenses, including payroll. So let's just think about it for a minute. If your business is open on a particular day, and let's just say, I'm going to use an easy number, let's just say on a day you have $20,000 in sales. So at the end of the day, after you've paid all of your expenses out of that, your bottom line is $2,000. So for that particular day, although you may have lost $20,000 in sales, when we're looking at your net income for that day, we're looking at $2,000. But in addition to that $2,000, we know there's some expenses that you're going to continue to incur during that day when you're unable to generate that gross income. We're going to reimburse you for those continuing expenses. And one of those is if you do continue to pay your payroll, you have the option of the continuing payroll as well. So when you think about it, your P&L, your financial statement, your tax return, look at what your sales are at the top, go way down to the bottom, then add back the expenses that continue. And that's primarily how all forms are written by ISO and how we're going to measure business income loss. That CP0030 also has a 72-hour waiting period for your business income coverage. So if you have a loss, we're going to wait 3 days before we're going to start to measure your business income loss. Those first 3 days is kind of like a time deductible. It's not a dollar amount, but it's a time period that you have no business income coverage for those first 3 days. So it has a 72-hour waiting period, usually has a limit of coverage. You have a limit, and that's why that BI worksheet that was sent to you can be used to determine the limit that you need for your values at risk, and it usually has a coinsurance requirement or coinsurance percentage. So I'm going to talk a little bit about what that means because there's a lot of misunderstanding about what coinsurance really means. The CP0032 is not written on an actual loss sustained basis. So therefore, it has to have a coverage limit on it because we're not going to pay whatever your actual loss is. We're only going to pay up to a maximum of the limit on your policy with any effects of a coinsurance deficiency or compliance. But with any policy that you have, any kind of primary coverage there is on your business income form, there's an endorsement that you can change that. The nice thing about insurance, you've got your primary, then any endorsement that there's just tons of them out there, and I'm only mentioning a few that can change that coverage. So you decide that your business is not of the kind that you want to wait 72 hours for your business income coverage to kick in. You can endorse a form onto that. You can have the 1556, which is going to completely eliminate that 72-hour waiting period, and you're going to start your business income coverage at the time of the direct physical loss. Or you can have the 1555, which is going to reduce that 72 hours to 24 hours. So again, think about the nature of your business. Think about if you can actually wait 3 days for the beginning of a reimbursement of an income loss from your insurance company, or can you wait 24 hours? The coinsurance that's on the policy, usually there's a limit and then a coinsurance. The coinsurance percentages we see primarily are 100%, 90%, and 80%. And that does not mean that if you have, let's say, a limit of $100,000 and 100%, we're going to pay you 100% of that $100,000 in the event that you incur that loss. It means that your values and risk have to be 100% in compliance with that $100,000, and then we'll pay you full reimbursement of your loss up to the limit on your policy. The 90% the same way. We determine values at risk. you have to have a limit on your policy that represents 90% of your values at risk, or 80% of your values at risk. If you are not fully insured, then you will not be fully indemnified for any loss that you incur, no matter how small the loss or no matter how large, even if it goes up to the limit on the policy, because chances are you're not going to get to the limit on the policy. Coinsurance itself, hey, if anybody has questions as I'm going, please, I didn't say that. Please feel free to stop me, because unfortunately I'm one of these people, when I start talking, it's hard to cut it. But coinsurance on the policy, on the CP 0030 or 32, there's only 12 specific expenses that you will see on your financial statement, your profit and loss statement, your tax return, that we can exclude in your values at risk. The policy is very definite about what expenses are not included in the values at risk. So as you go back to your office today and you look at your profit and loss statement, think about everything that's listed on there would be a value at risk, with the exception of these 12 things. If you have outgoing prepaid rent, that would not be included. Returns and allowances, discounts, bad debts, collection expenses, your cost of raw stock or factory supplies. Again, your cost of goods sold primarily would not be included. If you purchase merchandise for resale, that would not be included, because that too would be a cost of goods sold. Other supplies that are consumed in your production would not be a value at risk in the event that we're measuring your coinsurance compliance. And the cost of outside services if they're under contract that do not continue.
By the way, hang on just a second, Marianne. On the business interruption worksheet that we provided to you, we do not have these things on there. It's a real simplified business interruption worksheet. But if you need this information to take back with you to your office, let me know and we can get it to you.
The 3 additional expenses, power, heat, and refrigeration, and payroll expenses, those 2, if you do not want either of those included in your value at risk, you have to have another endorsement on your policy. If you do not have the endorsement, the 1511 or 1510, then they are going to be included in your values at risk. And the last thing is a mining operation and some depletion things involved in that, which, unless you operate a mine, you don't have to worry about that. But we're going to include all of your expenses found on a profit and loss, with the exception of these primary 9, and the 2 of you have endorsements, in your values at risk for coinsurance. So I think my next slide, I'm going through a little bit of an example of how coinsurance is measured. If your annual net income, let's say, is $159,277, you add back your operating expenses, including your payroll, with the exception of those 9, your values at risk are $410,003. If you have an 80% coinsurance requirement, you are required to carry 80% of your values at risk as a limit. So the required limit that you should have on your policy is the $1,128,002, because coinsurance is measured on the most recent 12 consecutive months prior to the inception of the policy or the last anniversary date. So we're not going to just look at 1 month. We're going to look at 12 months of net income, 12 months of these operating expenses, and that determines your value at risk, because a policy is actually written for 12 months. So let's just say in this particular one, you had a limit on your policy. You thought, well, I'm never going to have a total loss. I'm never going to have to worry about a loss for more than a short period of time, so I'm only going to carry $750,000. When I compare that $750,000 to the $1,128,002, you're 66.49% in compliance on your coinsurance. You have a deficiency of 33.51%. What does that mean, and how does that affect you? What that means is if you have now incur a $100,000 business income loss, we're only going to pay $66,490 of that $100,000, because that is your compliance percentage. You're a deficient 33.51%, so you have $33,510 in an uninsured loss if you're not fully in compliance on your coinsurance. And I've been doing this 32 years, and I constantly have insureds say, well, I never thought I would have a full loss. I really just thought you were going to pay me 100% because that's what my percentage is. A lot of people just don't understand the repercussions of this. If you have a $2,000 loss, we're only going to pay $1,200 and some, and $1,300 and whatever dollars of it. We're not even going to pay the $2,000 because you're only 66.49% in compliance. That's across the board. It's not just if you have a limits loss. It's any loss that you have that incurs a business interruption measurement, you're going to have a compliance percentage and a deficiency percentage unless you're 100% in compliance on the coinsurance. I just see it so much, and I've been seeing it for so long. There's just that misunderstanding of what coinsurance really is. And unless you see numbers in front of you and then you think about your own business and how this could impact you in the unfortunate event that something occurs, you have a fire, water damage, whatever, roof collapse, this is how you're going to be affected in the measurement of that business income loss.
Really what happens, people forget this coverage. They write their policy and they just forget about it. They don't think about it. So you really need to focus on business interruption and coinsurance especially, at least every couple of years. Do the worksheet, take some time, and so you know you have that covered.
And as I mentioned earlier, anything you have on your policy can be changed by an endorsement. The unfortunate thing is ISO does not have an endorsement that will turn it into an actual loss sustained policy. And an actual loss sustained means you have no limit, your coinsurance doesn't matter, it's whatever your actual loss is that you incur for 12 consecutive months. But you would have to check with your agent or broker, and they'd have to check with the insurance company you're going with. There's a manuscript endorsement, and I'm pretty sure every company has them. I know Liberty Mutual does. We have about 3 or 4 different ones that you can actually eliminate that coinsurance percentage. You can eliminate that limit on your policy with a manuscript endorsement. Insurance policies are kind of like going to the grocery store. You know, you buy your primary things and it costs you a certain dollar amount, but then if you want to add or change anything on that, there's a little cost associated with it. So every endorsement you have, everything you change off the primary policy, everything you want to add or delete, there's going to be some sort of little price tag associated with it. So it all comes with a price, but you have to determine what's best for you, what's best for your business as you look at your business income insurance. But the actual loss sustained endorsement, if you are able to get the manuscript one thing it does not do, it does not eliminate the 72-hour waiting period. That's still there. You would have to have another endorsement to get rid of the 72-hour waiting period or reduce it to 24. But what it does change is when the business income insurance or coverage ends. And the definition says it's the date that your property at the described premises is repaired or replaced or rebuilt with reasonable speed and quality. Reasonable that's one of those words that everybody has a different connotation of what that means, but that's what it says. The date when the business is returned to a new permanent location if you decide you can't rebuild where you are, or your landlord, if you're a tenant, does not rebuild for you and you have to move elsewhere. Or at most, that actual loss sustained will give you 12 months of coverage. The thing with the CP0030, if you don't change it to an actual loss sustained, and you have a small loss that continues for a long period of time, it can go way past 12 months. I've measured them up to 36 months already, where someone, just a portion of their business just didn't get back up and running. They couldn't get the equipment, they couldn't get it, whatever. So it can go on forever up to the limit on your policy, but if you change it to an actual loss sustained, you are limited to 12 months from the time of direct physical loss. And the reason I mentioned the reasonable speed is the unfortunate thing now is back when I started in the business, it seemed like a lot of people who had businesses and had insurance, they also owned the building they were in, which is now the exception rather than the rule. Most of our insureds are tenants in a business. Therefore, when there is some sort of damage, you know, you have to wait to see what your landlord is going to do. And some of them really drag their feet. Some of them do a lot of things to cause you a lot more distress because they're not getting you back up and operating as quickly as you could, and the insurance company, we have to work with that as well if you can't find a new permanent location to go to. You can also remove the coinsurance on your policy with three additional things, three additional coverages. One is called an agreed value, again, a little price tag associated with it. But what that does, if you have $1,028,000 in coverage as a limit on your policy, and 80% coinsurance, what that does is remove the 80%, and that $1,028,000 now becomes the agreed value that we say is your limit. So you have an insured loss after 72 hours up to $1,028,000. We've agreed that's your amount. We've gotten rid of the coinsurance. Another one is a monthly limit of indemnity, and we see these most of the time as 1/2, 1/3, 1/4, and 1/6, and don't tell me why they came out that way, small, big, whatever. But these are the fractions that we see. And how this also gets rid of your coinsurance. It keeps your limit, but it gets rid of your coinsurance. So I'm going to use an easy number here. Let's just say if you have a $100,000 limit on your policy and you have a 1/4 monthly limit of indemnity, the most you can incur and will be paid for in any one single month is $25,000. That's 1/4 of your limit, and we will pay you up to the limit on your policy if need be, if your loss goes on that long. So in that first month, let's say your loss is $35,000, you have a $10,000 uninsured loss. And if that continues, you will hit your $100,000 in 4 months, and your coverage is over, your business income loss, we've exhausted the limits on your policy. However, if you have a 1/4 monthly limit, let's just say your loss is only $15,000 each month. You will get reimbursed for that full $15,000 as measured, but then we can extend it past 4 months because we can go up to the limit on your policy. So you would have coverage for about 6.5 months, if need be. But all that does is give you a monthly limit, a monthly maximum amount that we can pay you based on your limits on your policy and the fraction that you choose. The third one is the maximum limit of indemnity. This works if you, let's say, just use the $100,000 again. That's an easy number for me. And you have a maximum limit of indemnity, which is 120 days. We will pay you whichever comes first. If you get up to $100,000 in 2 months, you've reached your limit. If you get to 120 days before you've reached your 100,000, we stop at 120 days because that's your maximum limit, and it's either one, whichever comes first. So these can also change the coinsurance on your policy. So as I'm going through this, I hope you all go back and pull out that policy or call your agent and say, what's my business income coverage? What do I have coverage for? What are my endorsements, and what do I need? Any questions on the CP 0030? Commercial property, yes.
I have a question. You referred to when you lease a building, and I think there's a lot of misunderstanding with these leases. So in order to trigger business interruption coverage, you have to have a covered loss. And so if the loss is to the landlord, how does that trigger your coverage unless you have a triple net lease where you're obligated to pay the insurance on the building?
If we insure the landlord, then they would have to have a less, an owner's risk policy. The tenant. If the tenant owns the building?
The lessee has business interruption
Okay.
insurance, but is leasing the building and doesn't have a triple net lease.
Okay. Then we go to the lease, and we look to see under damage and destruction, what is the verbiage as far as does the lease continue or not? If there's an abatement clause on the lease, then that tenant gets to abate their rent, and they do not have to pay it. And it usually says in proportion to the amount of space that's untenantable. So if it's a total loss and you can't be a tenant, you can't operate in that building, according to the contractual agreement you have with you and your landlord, you don't have to pay rent because it says it right there. So that is now a non-continuing expense for the tenant. And then you would hope that the landlord has insurance elsewhere where he can pick up the loss of rental income expense. So it can go both ways. I mean, they could each have coverage separately. Sometimes we insure both. So it's a...
Well, that just handles the rental portion of the building.
Right.
What about the loss of...
The whole business income loss, as long as they have coverage for the business income loss, they're covered. Unless we can find them a new permanent location, They're kind of at the liberty of the landlord until the landlord gets it repaired and they get back in. So without meeting any other of the other terms as far as the limit, the time frame, whatever, they're covered under the business income because they've purchased that coverage from the carrier. Did that answer it? Yes.
If you're a tenant, and let's say we use an example of a strip location where there's multiple tenants, and my individual box doesn't get damaged, but the one next door to me is, and it causes that because the landlord won't let it. Yeah, how does the just standard policy language figure out if it's not my location, but the one next to me?
If you're not allowed in, it's usually by the fire department or the police or somebody like that, and it's called civil authority. I'm going to talk about that in a minute. Yes, there's civil authority coverage on your policy, and that's when you're restricted or not allowed access to your property. And you're not allowed, you can't conduct your business, you're not allowed there. Same thing as like an evacuation. If there's a wildfire or some kind of explosion or something, they won't allow anybody in the area. Most policies will have civil authority coverage, so thank you. We'll talk about that. The next form that any other questions at this time? Okay. The next form I want to mention, because again, this is an ISO form. We see it out there all the time. It's called the Business Owner's Coverage Form. And this is one big long coverage form that covers your building, your personal property, your business income, your civil authority. I think it even has general liability on it. It's just one massive form that supposedly covers every aspect of your policy. If you have the CP 0030, you have to have the CP 0010 for your building. You have to have CG something for liability. There's all kinds of different forms, whereas this one kind of is all-encompassing. It's one form that covers supposedly all the needs as a business owner. The definition of business income is the same. It's going to start with the net income, which is your bottom line. You know, I often have people come to me and say, hey, I was closed for 3 days, my gross sales are $20,000 a day, you owe me $60,000. Well, not quite. Let's start with that $60,000, and let's determine what your net income was on that, and then we'll see what expenses you had that continued, and that's what your policy says you're covered for. Because that's actually your loss. You lost your net income, and you're out of pocket those expenses. That was your loss for that period of time. The definition is exactly the same, except this adds in the phrase that says that we will not pay you for a favorable condition that's caused by the impact of the covered cause of loss itself. A good example, let's say you're in an area where there's a tornado went through. Now you just happen to be on the edge of that tornado, so part of your building is damaged, maybe half of it, but every other hotel, motel in the area is flat. And then you come when it's time for your business income and you say, well, because of what happened, I was the only place open, and I would have been at 100% capacity, even though I was only at 20% capacity before, because all these people are coming into the area to adjust these losses, all of these agents are coming in, all of these insurance people. My place would have been packed every single day, and that's what you owe me for. No, it says we will not take that into consideration, because had that loss not occurred, had that tornado not come through, you probably would have stayed at 20% occupancy. So that's what we're going to look at. That's your loss. So this policy specifically says we will not pay you for a favorable condition. And then we go along a little bit further in the extended BI when we get to that, and it says we won't pay you for an unfavorable condition. So I'll talk about that in a minute. So the only difference in the definition here, it mentions that you can't benefit as a favorable condition, condition from a covered cause of loss. And again, we just usually see those in catastrophes. That's about the only time. Business owner's policy, 72-hour waiting period. It's your time deductible that you have on there. This also has something else. It only gives you 60 days of ordinary payroll. So with the policy itself, you can only pay your ordinary payroll for 60 days from the time of direct physical loss. And you're going to say, well, what's ordinary payroll? And although there's not really any definite line that says what's ordinary and what's not, because everybody's business is a little bit different, and I think I might have a slide on this, I might be getting ahead, but ordinary is usually hourly folks. Your salary people are usually your key people. Those are the people you're going to need to keep past that 60 days, chances are, unless you're not going to reopen. But your hourly people are primarily going to be your ordinary payroll. there's exceptions to that rule too. You know, you might have a key person that you never put on salary, but, you know, he might run your CNC machine or something. He might be your controller of that, and he's an hourly person, and you want to make sure that he's there when you reopen. So those are conversations you have to have with your adjuster to determine if there's somebody that maybe we would perceive as an ordinary payroll person, you would perceive them as a key person. You need to have those conversations with your adjuster up front as to who you see as key and who's not. So you get 60 days of ordinary payroll. That's it. And this is also written on an actual loss sustained, which means there's no limit, there's no coinsurance. It's actual loss sustained. The only thing on the actual loss sustained, it's up to 12 consecutive months after the time of direct physical loss. So if your loss goes on, if you're having problems there with your landlord getting that building up, and it goes on for 18 months, you've got coverage for 12, and that's it. The 72-hour waiting period, again, what did I say? An endorsement can change it. You can have the BP 0441, it's going to eliminate the waiting period. The 7919 and the 8816 are going to reduce it to 24 hours. The 7919 only reduces it to 24 hours for off-premises service utility interruption. We'll talk about that in a minute too. All of your other coverages, it keeps at 72. It's only the services interruption. So you can endorse it to change it. If your business cannot wait 72 hours before you start to be reimbursed for that business income loss, then you need to have an endorsement on there to change that. Here I just went through the basic rule of thumb on ordinary payroll. I kind of got ahead of myself. But again, as I say, it's not written in stone. Every business is unique. You've got some key people who are hourly, but primarily I would say your salary folks are your key people. They're your managers, they're your supervisors, the owners. Those are the ones that the 60 days does not apply to. But again, you can have those discussions with your adjuster or your auditor at the time that your business income loss is being measured, or early on before we hit the 60 days. And as I said, what it really means is if you have the 60 days, you decide you want to be a good employer and you want to continue to pay those folks after the 60 days, you can do that. We can't tell you not to. The policy can't tell you not to. It's just that you're not going to be covered for it. It's out of your own pocket. You will not be reimbursed as that as a continuing expense. So do think about that. That's we see most of the policies coming through anymore to have that endorsement that eliminates the 60 days of ordinary payroll. You can have these are the endorsements that can eliminate it. You have a 7076 and a 7919. Both will eliminate your 60 days of ordinary payroll, which means you can pay those folks for as long as you choose to. I think the policy does also say, if you look under the how loss is going to be measured, it says the necessary employees, and it does say necessary to resume your operations at the level it was on the date that the loss occurred. So as a person doing this for 32 years, I have a really, really tough time with somebody who owns a restaurant telling me that their dishwasher is a key person, or their bell person who busses the tables, because you certainly, before you reopen, the insurance company would offer you that payroll to train people. So if you have those jobs that are not so skilled and they can be trained within a few weeks, you would have that continuing payroll at that time. That would be some pre-opening costs for you, perhaps even measured as an extra expense to get reopened, depending on your carrier. But you have that option. So I sometimes, when I have these discussions with an insured, I have a hard time understanding why all of their employees would be necessary when you can train them to do that perhaps unskilled job within a reasonable amount of time. I'm going to talk a little bit about the period of restoration, and there's a lot of misunderstanding on what the period of restoration is. It's pretty easy to see that on the policy, 72 hours. You've got 72 hours from the time of direct physical loss till your period of restoration starts, unless you endorse it to change it otherwise, to eliminate it, or 24 hours. When does it end? Well, the policy specifically says the date when the property, the described premises, should be repaired, rebuilt, replaced with reasonable speed or similar quality, or the date when the business is open in a new permanent location. As I said, one of the things we see now is landlords who drag their feet. Is that really the tenant's fault? Then we have to look on the other side. Did that tenant diligently try to find a new permanent location or a temporary location, really, to operate during that time? We're looking probably more at a new permanent location. Is there space available? What is out there that they could have relocated to? But the policy specifically says reasonable amount of time. Now, I'm going to tell you, we had recently a small fire in a laundry, commercial laundry, or, one of the people where you go and wash your clothes, one of them. 3 dryers burned, a little bit of smoke damage. Well, this insurer decided that he wanted all new washers and dryers in there. So he kept putting off, saying, this is wrong, that's wrong. There was nothing wrong. We had cleaned the dryers. We had everything. They were running, operating, everything. There was nothing wrong. He just wanted all new equipment. So he stayed closed for about 5 months, waiting for Liberty Mutual to buy him all new dryers and all new washers. Well, when it came to the business income loss, reasonable speed, and things were repaired and ready to operate within 3 weeks, we measured a 3-week business income loss. Well, of course, he's very unhappy. We didn't comply with the terms of the policy, but we did. Reasonable speed. We got somebody in there to do that cleaning right away. We got a ServPro or somebody in there right away to do the cleaning. We got somebody in there to repair and make sure that those dryers were operating quickly, all within 3 weeks. But he had decided that he wanted all new equipment and decided not to open. So reasonable speed, and that's something you need to be communicating with your adjuster or through your agent to the adjuster. What is reasonable speed? What are they looking at as the amount of time it should take you? Now, sometimes, we may perceive that it's not reasonable speed, but there may be reasons beyond your control, beyond our control, as to why it did take longer for those repairs. So that's specifically when the period of restoration ends. And it's conversations you need to be having up front and throughout the period of restoration with your adjuster to make sure that you're both on the same wavelength as to when that's going to end, so that you're not sitting there not operating and the insurance company's way on the other side saying, I don't know why they're not operating. I don't know what they're doing, Have those communications up front. Talk to your adjuster. Make sure that you both are on the same path, same ideas when repairs would be done within reasonable speed, and that way there's no surprises anywhere down the road. On an actual loss sustained policy, as I said, you can have a manuscript endorsement on the CP 0030, or you can have the BP 0441 that are the BP 0003 is an actual loss sustained policy. What I guess I'm losing it here. The 72 hours is still there on all actual loss sustained, because the definition of actual loss sustained does not at all deal with the first part as to when the period of restoration begins. It only defines when it ends. And on the BP 0003, again, when it's repaired with reasonable speed or replaced or at a new permanent location, or 12 months at the most. So if you are going to drag your feet, your landlord's not going to do anything, you're going to think that we need to replace all your washers and dryers, and you wait past 12 months, in the event 12 months was a legitimate number, that's all we would pay anyway. We won't go past the 12 months on an actual loss sustained policy. Every policy has an extended business income period. We kind of refer to it as a ramp-up period. If you're closed for an extended period of time, when you reopen those doors, chances are, if you have a grand reopening, you're going to have a boom the first week, but you may not get back up to your regular sales for a while. Most policies used to have a 30-day extended BI, but some of the later versions of the BP 0003 and the CP 0030 have a 60-day extended BI. So that means from the date that your period of restoration ends, you've got up to 60 days to get your business back up to its pre-loss levels. Now, if you get up to it before the 60 days, then your extended period is cut off because you're already back to a pre-loss level. But you have up to 60 days to ramp that business back up. So it's not like you're being cut off right away at the end of that period of restoration. We're going to look at another 60 days. We're going to look at your sales, where your sales should have been, measured by looking at trending, historical information. Where should you have been during those 60 days, and where are you? And are you still incurring a business income loss? Couple of things, though. In the extended business income period, there's no coverage for extra expense. So if you think you're incurring some extra expense during that time, there's no coverage. That ends at the end of the period of restoration. But it begins on the date the property is actually repaired, rebuilt, and replaced, and the date you restore your operations, or 60 days after that date. So it's a maximum of 60, up to 60, and it starts when your property is repaired and replaced and you open the doors for business. This is where I said about the unfavorable condition in the extended BI. Lots of times, I remember, don't we all, Hurricane Katrina. I spent a lot of time down in New Orleans or in that area during that time. But some of those businesses are never back up to where even today are not back up to where they were because people didn't move back in. So you can't have an extended business income because of an unfavorable condition caused by the covered cause of loss. So because Hurricane Katrina, everybody moved out. Now the businesses are repaired, replaced, reopened, but there's no customers because nobody's there. Everybody's moved to another town. You don't get an extended business income period for that reason because it's an unfavorable condition. Nobody had any control over that hurricane. It wasn't anybody's fault. People moved away, so you have no extended business income. So generally, when there's a catastrophe comes through, there's not really any extended business income coverage because most of it is going to be as a result of an unfavorable condition from that direct physical loss that occurred in the area. Tornadoes, hurricanes. Yes?
What if you make a product and because of your temporary closure, your customers find other suppliers and your business never returns above 75% of its previous level?
You have 60 days. However, let me take it one step further, and I didn't talk about that here. Remember what I said you can do on any policy? You can endorse it. Now, if you have a business like that, and I just had one recently. Actually, I'm still working on it. It's a result of the wildfires in Gatlinburg, Tennessee. They have 365-day extended business income. So the repairs are complete. Now I have to look up to 365 days to see when their business got up to pre-loss levels. So if you feel the nature of your business is such that your customers are going to go elsewhere just because of the product that you make, and you may not get those customers back, then you might want to talk to somebody about extending that. You know, you can do it 90 days, 180. Like I said, I've seen them up to 365 days. Other than that, you get the 60 days, and that's it. Off-premises utility coverage. Neither the CP 0030 or the BP 0003 cover you for a loss of business income from an off-premises utility interruption. What's an off-premises utility interruption? Well, if a transformer blows down the street and your business can't operate because you have no power, a storm comes through and takes down the wires down the street, not on your property, but down the street, and you have no power. You can't operate. You can't get generators in there to operate. If you have one of these forms, unless you have an endorsement and change it, you have no coverage for off-premises utility interruption. So you have to endorse that onto the policy. CP 1545 adds it to the CP 0030, which is the commercial property policy, and the 7919 adds it to the BP 0003 with a 24-hour waiting period. I'm looking around, I see people's eyes rolling thinking, how in the heck am I ever going to remember any of this stuff? Well, talk to your agent, talk to your broker, find out what coverage you have. And this is all just to make you aware of business income coverage, what you may run into in the event that you have one of those devastating losses that Don talked about, and just to make sure that you understand and you have proper coverage when one of those does happen. Civil authority, you brought this up a minute ago. What's needed in order for you to have civil authority coverage? You have to have an order by civil authority, and it has to be due to a covered cause of loss, and it has to be at a location other than the premises that's described on the policy. So, you have to have, it's usually the fire department, the police, somebody who restrict access to your area. They will either usually make that available to you, or lots of times you can get it off the media. You can find out what areas are restricted, where you can't get into. Maybe not so much in a strip mall, but they should be able to give you something that says you're not allowed access. And it's a covered cause of loss, so it has to be something that's covered, water, fire, whatever the damage is. And it has to be at a location other than where your premises is, as noted on the policy. That could be your guy next door. He's not on your policy, he's next door, he caused you to lose business, so you've got the civil authority coverage. And the loss of income, again, will begin 72 hours after the time of the order, and extra expenses do begin right away, though, if it does have extra expense coverage. So again, that 72-hour waiting period is there. That time deductible is what it really is, but you do have coverage for that, and all of that has to result in a loss of income to you, and that is available to you on your policy. Civil authority is both on the 0030 and the BP 0003. Now, there's some new forms out there on civil authority. I should mention the original forms had, you had coverage up to 21 consecutive days after the time of the order. So it would give you up to 3 weeks, because primarily within 3 weeks, that order should be lifted and you should be back in. If not, the old form gave you no coverage. You had 3 weeks, that was it. Oh, what did I do? Oh, there. Okay, now some of the newer forms that we have, it's really interesting because you still have the civil authority coverage, but you don't have to have an order that evacuates you or restricts access to your property, but there has to be an order within a mile of your described premises. So if you're operating a business here and a mile down there's let's say a wildfire. We have so many of those in California, and I talk about them all the time. A mile away there's a wildfire, and they have evacuated the area and there's restricted access there. You can file a business income coverage, business income loss, if your business is affected, if you're within 1 mile of where that order was given. That's unique, because we didn't used to have that. And this also extends it up to 4 weeks instead of 3. So the newer coverages you're getting probably on your renewal policies are going to give you up to 4 weeks on civil authority, and you could be within a mile. You do not have to have a direct order from the authorities that say your access is restricted. That changes it just a little bit. How am I doing on time? Okay? I think I'm okay. All right. I'm going to talk a little bit about, that's pretty much what I'm going to talk about in coverages. Any questions on coverages? Anything I wasn't clear on? I see a lot of deer in the headlights looks. What I'm going to talk about now is your financial statement, your profit and loss statements. We're going to discuss some types of expenses and how, if you're doing that business income worksheet, how you should look at those expenses, how we look at them from a forensic accounting perspective. We're going to go through a couple of scenarios where you're going to calculate some values at risk, just to give you an idea how values at risk could change depending on what your coverage is, on what your limits and coinsurance is. We're going to look at net income and continuing expenses, a little bit more on coinsurance compliance, and then what your actual lost payment is. So we're going to go through a couple scenarios, and you can maybe put yourself in, think what your limit is on your policy, or if maybe you have an actual loss sustained. First of all, this is pretty much an annual profit and loss statement. As you know, you've got your gross sales, cost of goods sold, gross profit, and all of those operating expenses. So you started out, you sold $2.247 million that year. Your net income was $266,000. So if we're determining values at risk, that $266,000 is our starting point. That's your net income for 12 months. We're going to look at that as the starting point of the net income. Then you're going to have the operating expenses, except for those 9 or 12 that we talked about, and how they are going to factor into your values at risk. So you have the $266,000, and remember, unless you have the endorsement, all payroll is included in the values at risk. The only thing we don't include is supplies that are consumed in production. We don't include collection fees, which is basically a credit card fee. It's been deemed that that's what that is. So of all of your expenses there, going back to the 12 that are listed on the CP 0030, all of your expenses can be considered a value at risk, with the exception of the credit card fees and the supplies. And of course, your cost of goods sold, because we're starting with your net income. So on your values at risk, on a net income of $266,000 would be about $1,029,010. Now, if you're looking at net income, and I'm moving away from your values at risk for a minute, moving away from net income and continuing normal operating expenses, expenses kind of fall into two buckets. You've got fixed expenses and variable expenses. Fixed are normally going to be your continuing expenses. Variable expenses are going to be the non-continuing saved expenses per se. And again, another general rule of thumb, again, not written in stone, a fixed expense is normally something that's generated by an outside concern, something where you get a bill for. Your insurance company is going to keep billing you whether you're closed or not. If you have interest expense at the bank, you're going to keep being charged for that. Property taxes, the county or city or whatever is going to keep charging you property taxes. You're going to keep getting those. A portion of your utilities are going to continue, because that's kind of a semi-variable expense. That's kind of fits both buckets. But most of your expenses are going to continue. Now, I put some question marks up here because when you're looking at it, or when we're looking at it from a forensic accounting perspective, we say, okay, we expect the compensation to officers to continue. You're entitled to continue to pay yourself, and you should. You are covered under the policy, so you should continue to do that, unless you decide not to reopen the business and you close the doors for good. Now, your salaries and wages, that's going to go back to are you going to pay all your folks? Are you going to pay just your key folks? Who are you going to continue to pay? So that $268,742 could be something less than that, because you've decided at that point there's a few folks you're not going to continue to pay. Now, my conversations with my insureds, and I don't have that many anymore since I'm a manager, but used to be, this is a good time if you want to weed out your employees. This is a time to do it. We're just talking about this, behind the doors here, because if you have some employees now that there's been some issues with, you have to deal with it tactfully. But this is a time and an opportunity where the business is not open, and maybe that's where the decision should be made to part ways. That's something for you to think about. But you also, again, have to think about how skilled are your employees, and how many of those folks can you retrain within a few weeks prior to reopening. So you may not have all of your salaries and wages as a continuing expense. I put them in here all as continuing just for my example. Repairs and maintenance. If your doors are closed and you are not operating, the only continuing repairs and maintenance should be what's being done by the insurance company. They should be doing the repairs to get you back up and operating. It should not be an expense of yours because you are not operating. Now, if you're partially operating, of course, then there's going to be something continuing there. Rents. We're going to look, as I mentioned earlier, what are the terms of your lease? You have a contractual agreement between you and the landlord. What does that contractual agreement say? You both signed it. Is your rent abated or is it not? Some portion abated. Some say just base rent are abated. Some say all rents payable are abated. Some say you have to pay for 120 days, and at that time, you can decide to terminate the lease. So all of them are a little bit different. You want to know what the terms of your lease are as far as abatement clause too. And it's usually found under the damage and destruction area on your lease. That will tell you. So rents may or may not continue. Taxes and licenses, your taxes from outside, licenses are going to continue, but lots of businesses put their payroll taxes in with their taxes and licenses. We see it all the time. So if you're not paying some portion of your payroll, you're also saving some portion of your employer payroll taxes. So that portion, there could be a proportionate amount there. That's a saved expense. Interest, the bank's still going to charge you. They don't care. Depreciation, and I put a question mark there too, because if you happen to own the building and the building is totally destroyed, I think the IRS says you can depreciate a building for 40 years. That's an accelerated method. I think a more realistic method is to say a building's going to last probably 100 years. Well, we wouldn't look at an accelerated method then, but if your building is totally destroyed and you're going to build a new building, you're going to have the advantage of a higher depreciation to reduce your taxes when that building is completed, because now you're starting all over. But some portion of that building may be a saved depreciation. Yes, people say it's just a paper expense, but it's a valid IRS expense. But we have to look at it as a useful life and not accelerated, because that is not fair to the insured. So maybe you have a huge piece of equipment that cost $300,000, and that's totally destroyed, and you're going to get a new piece of equipment. You may be depreciating it at 20 years. What's realistically? Would it have lasted 40 years? You know, we usually like to make the useful life as long as possible to make the impact of that saved depreciation on you as minimal as possible. But looking to the other side, now when you replace that piece of equipment, it may cost you $500,000 now. Now you're starting with a brand new asset, a brand new accelerated depreciation at $500,000 instead of something that already is partially depreciated and the original cost was only $300,000. So you've got an advantage now of a higher dollar expense to reduce your net income, your taxes payable to the government, and you also have it now for a longer period of time because you got a brand new asset. So it's to your advantage, and we try to make that impact on depreciation as realistic as possible. Advertising, if you're closed for a long period of time, depending on your advertising, it's going to stop. Grocery stores especially, you know, if you run ads every week, you're not going to keep doing those. If you're in the Yellow Pages, yeah, if that's your only advertising, yes, that's going to continue. Alarm and security, depends. Bank charges, those little fixed charges from the bank, yeah, they'll continue. Credit card fees and supplies should not continue. Utilities, if you're an energy high type business and now you're not operating, maybe you won't see the impact immediately, but after a couple of months, it's going to go down to just your fixed charges on there. The only thing that could happen there, we also take this into consideration, if you have construction folks in there rebuilding and running all kinds of equipment, your utility bills could be as high as possible, so there may not be any saved expense there or non-continuing expense. Insurance is going to continue. Workers' comp will only continue if you pay your employees, although you may be charged a set workers' comp each month by your carrier. At the end of your term, whether it's a year or 2 years, they make an adjustment to your actual payroll. So if you overpaid, you get money, you get a credit. If you underpaid, you owe. So your workers' comp is not going to continue in the long run because you're not paying those folks. Legal and accounting, normally you still have an accountant doing your books. And amortization, if you have that on your financial statement, that's going to continue as well. Everybody knows what amortization is, right? Yeah, good. I always have to tell adjusters that, they go. So anyhow, on this particular loss, your net income for a year and continuing expenses could be $982,007. That could be what the insurance company owes you in the event that you're fully insured and you have no co-insurance deficiencies. So let's go on a little bit further here. Let's just say on that policy, you had a CP 0030, and you decided that $650,000 limit, because you're never going to be totally shut down. We hear that all the time. It's never going to be for more than a month. It's not a big deal. And you have 90% co-insurance. So if you see over here, I calculated values at risk on the second column as $1,029,010. So those are your values at risk. Your required limit on that is 90% of your values at risk. So that would be $926,019 would be your required limit to be fully insured for every loss that comes down the road. You have $650,000. So now you've got a compliance of 70% and a deficiency of about 30%, which means on any loss that you incur, you're only going to get 70% of that loss. I measured net income and potential continuing expenses at $982,000. You're going to be reimbursed for 70.19% of that. The insurance company's loss payment to you would be $689,270. That's a big chunk for you to handle on your own just because you didn't have sufficient coverage on your policy. But that's the result of a coinsurance and not being fully insured. And I think just so many times we just don't understand what the impact of that percentage is, and you choose your values at risk. And I was just telling Don, that worksheet he sent to all of you, I have no idea what agency it came from, but it went to one of our underwriters the other day, and they sent it over to me and they go, does this look right to you? I hate when they do that. So I went back and I looked at what the insured had determined as their values at risk, their little note saying we will never have a total loss, we will never be shut down. So they picked a nominal amount for their values at risk and then a coinsurance percentage. And I think they chose 90%, I can't remember. So I went back and I looked, I said, well, first of all, if these are their values at risk and this is the limit they chose, they're only about 20% in compliance on their coinsurance. So even if they had a loss of this size, which they chose as their limit, we'd only pay 20% of it. So I think their values at risk were over $4 million, and they were going to be 80% underinsured, and then they had a lot. They said their limit was going to be, I don't know, 900 and something. I forget what it was. And they would only end up getting 20% of that. So if they lost all $4 million and got 20% of the 980, that's not really a good reimbursement on a $4 million loss. So just think about that if you have the coinsurance. If you don't have to worry about it, but I just see it all the time, and to me it's very unfortunate, but I don't write the policies, I just audit them. A second scenario, if you have the $650,000 and 100% coinsurance, which does not mean you're 100% reimbursed for every loss, it means you have to be 100% in compliance on your values at risk. With a policy limit of $650,000, you'd only get 63% of that loss. So, any questions on coinsurance? If you don't have it in your policy, you don't have to worry about it. If you do, go home and look at it. Call your agent, call your broker. All right. When a policy's written, if you're an insured or an agent, some things you really need to take into consideration, and I think I've really harped on the values at risk. What do you have as far as a net income and expenses that are going to continue that you want to make sure that you're fully insured for in the event that you have a loss of any dollar amount up to the limit on your policy? What you want to make sure you know your values at risk. You also want to look at the policy verbiage and see how the loss is measured. And as I said, if you have an ISO form, it's net income plus the continuing operating expenses, including payroll. Some of you may, with whoever you're insured with, have a manuscript form by that insurance company, which could be written differently. Liberty Mutual has some manuscript forms, which I'm really not going to talk much about, where it's written as loss of gross receipts, which is top line, less saved or non-continuing expenses. Now think about it. If you go to net income and add back what continues, or you measure gross receipts less what doesn't continue, you should have the same number. It should be the exact same number, but the verbiage on the policy could be different. So you do want to know what the verbiage is on your policy. I always say you need to know the nature of the insured's business. What type of business are they in? What waiting period, what loss can they afford to pay themselves without reimbursement from the insurance company. And trust me, you do have insurance for a reason, and that is to reimburse you for your losses. I told you about my fire loss last year. 2 years ago, living in California, I'm going to go off a tangent here. There's two kinds of houses. You've got houses with termites and houses that are going to get termites. So every year you've had your annual termite inspection. I was home from work one morning, and this was about a year after my husband passed away. I was upstairs working in the office, and my termite inspector came. I thought, oh, good. He said he'd be out of here by noontime. I can go to the office. About 3 minutes to 12, I heard this horrible sound. He was up in my attic, stepped on the main pipe to my fire sprinkler system in my house, destroyed my whole house. Long story short, I lived in a hotel for 5 months. Whole inside of my house is new. They had to knock out all the walls and everything. So anyhow, I was glad I had insurance. Both times I've been glad I had insurance, and I was glad I was fully insured. And I remember my husband used to come to me and give me the policy and go, are we fully insured here? So luckily I had a little input on that. So make sure, you know the nature of the business. What can you afford to lose? What can you afford to pocket yourself, pay financially yourself in the event that you have a loss? Because that's what's going to happen. And make sure you have the appropriate endorsements on your policy. So I'm going to tell you a couple of things that have happened, losses I've seen over the years, and what devastation this can cause. The first one is, I think this was in Chicago years ago. We had a fire on February 12th that destroyed the contents of the building. CP0030, so it had a 72-hour waiting period. The insured was a florist. February 12th, 13th, and 14th. He had 60% of his annual business in those 3 days. What was my news to tell him? You have no business income coverage until February 15th. No one buys flowers on February 15th, and even if you forgot to buy that special person flowers on the 14th, you better not bring them home on the 15th, because you're going to go out the door with them. So this guy had absolutely no coverage for the 3 busiest days of his year that made up 60% of his annual business. That was devastating. I also had one that was a property management company, and they managed, and this was where we had some fires in California, managed a huge property of apartments and condos. They had no ownership in that property, and that property generated 85% of their annual management fees. The wildfires came through and destroyed the entire property. The management company had no dependent property coverage on their policy. Let me tell you what dependent property coverage is. Dependent property coverage is coverage you buy for a property that you don't occupy or conduct any businesses in. But you buy coverage on that dependent property if they are a major supplier of yours, if they provide raw materials, finished goods, whatever it is. If they're a source that generates, that you would lose a lot of income if that premises was destroyed, you want to carry dependent property coverage for them, so you would have a loss of income coverage in the event that that property is destroyed. Years ago, I had one. It was a women's accessory store in Beverly Hills, and they imported most of their stuff from one manufacturer in Italy, and his place burned to the ground. They had dependent property coverage. So we would pay them for loss of income up to the limit of dependent property coverage they had in the event that we could measure a loss of that size, because their property depended on that industry in Italy supplying their goods to them. This company had no dependent property coverage. They got nothing as far as loss of income. We insured the property management company. They didn't have any ownership in that property. Years ago, I had a restaurant in Inner Harbor. It was on the 4th of July. If you've ever been to Inner Harbor in Baltimore on the 4th of July, it's a huge weekend. Local festivals, craft shows, huge fireworks display there, just absolutely beautiful. And we had a restaurant that had reservations for like all weekend, starting like Thursday evening all the way through the weekend. Breakfast, lunch, and dinner. They said they were full capacity. Transformer in the area caught fire. Because it was a holiday weekend, They couldn't get a new transformer in there, one that would accommodate all the businesses in that area. So they had no power for 4 days. They had no off-premises utility coverage on their policy. So all that business they lost during the 4th of July weekend, there was no coverage for them for business income. I think I have one more. 16-story hotel building, 3 large banquet rooms, weddings in each banquet room on the Saturday. On Friday, they had severe water damage. You know how people in hotels, for some reason, let their tub run over. They decide to wash clothes and hang it on the sprinkler head. You know, stuff like that happens all the time. Severe water damage that came down and damaged, because it must have ran forever, all the banquet rooms. They had a 72-hour waiting period. They got no reimbursement for their loss of income from those 3 weddings, which would have had them at full capacity, not just in a hotel because of guests, but also the banquet rooms would have been full with the wedding receptions. Just some things that I've seen over the years where when you tell an insured that, as Don said, they look at you like, what foreign country are you from? Because they just do not understand that that's the way their policy was written, and there's nothing I can do about it. I can just interpret it what they purchased. So again, consider the nature of the business. Also, you might want to look at key sales periods, seasonality. You know, there's also endorsements that you can get on a policy called peak season. So if you happen to be a retailer who stocks up a lot of inventory for the holidays, and you want to have extra coverage for that inventory on hand because you might have a limit on your policy, you can get a peak season endorsement. We also can see peak season endorsements for things that are like on a boardwalk or something, where you know, you might want to look at their business, but you know, it's going to be peak at certain times of the year. We should see that in their sales, but they can also get those endorsements on there as well. So you want to know when their key sales periods are. What are those effects of the waiting period going to have on your business? What is a 24-hour wait, a 72-hour wait? How is that going to impact you financially? You need to know that. Sources of inventory. Where do they get their raw materials from? Where do they get their finished goods from? Who do they purchase from one person? Do they purchase from many so that if one had a loss, you wouldn't be impacted because you still have other opportunities to get your inventory and your raw materials in? And then most of all, if you're an agent or even if you're insured, are your needs being met by that policy? Because if you have a policy for business income coverage and it's not meeting your needs, then I hate to use the term, but you pretty much have a worthless policy. I mean, it's going to pay you something, but if it's not meeting your needs 100%, you're going to have to pocket a loss yourself. And how's that going to affect you in the end? So you really need to consider, is that policy meeting the needs? Anything on business income before I talk a little bit about extra expense? And I think I do have a little bit of time for this. So, yes.
Are there any other options on that, the waiting period other than 2472?
Yes. On a CP 0030, you can have the 1556, which eliminates it completely. So as of the time of direct physical loss, your business income coverage kicks in right away. And on the BP 0003, you can use the 0441, the BP 0441, that completely eliminates it too. So you could do that.
If somebody establishes a limit that's actually higher than what they can substantiate, then they're just wasting the premium. You haven't really mentioned that.
No, I haven't. And you know, that's interesting that you mentioned that. And I had one of those the other day. I was somehow over the holidays, you know, when everybody wants to take time off, and why should I take time off? All these losses come in. So I took some assignments myself, and it was one that it was an owner's risk, owned a lot of properties, had it on a blanket limit with a co-insurance. So my request for records was I need financial statements from all those properties to determine the total values you have at risk and if your co-insurance is in compliance. And they sent me all their financials, and I went back to them. I go, this can't be all of them. Yeah, that's all of them. Can you send me the tax returns, you know? And they tied into the financials. And they had a limit about twice of what would have been required. So I said to the adjuster that they should talk to the underwriter, because from what I can see, and they gave me rent rolls and all kinds of stuff, so from what I see, this insured is way overinsured and they're wasting money. So I usually I have my auditors try to talk to the adjuster through underwriting to go back and say, you've got this limit, but all records indicate that you don't need this limit. We don't see it very often because our underwriters are supposed to get those financial documents when they write the policy. As we all know, sometimes things slip through the cracks. Obviously, this either wasn't reviewed correctly. Another thing that did happen, there was 3 properties on there that were sold prior to the date of the policy was written. So they shouldn't have even been listed on there, but they were. So yes, we do see it once in a while. And, why should you carry insurance for something you don't need? And we try to, from our end, make them aware of it. And I have to tell you, coming from an auditor, I'm not sure whatever gets changed on those. You'd like to think that they do. But we see the other side more often where they're underinsured. Yes.
Last question that goes beyond a year. I've got a 50-unit apartment building that's 60% destroyed in fire or whatever. It's going to take 16 months to rebuild and probably another 6 or so months to be back to 100% occupancy. So we've blown past the 12 months after the period of restoration begins. How do I ensure that?
The only way you can get past the 12 months is if you have a limit on your policy and it's not on an actual loss sustained. That would have to be the CP 0030 or a manuscript form from your carrier of that sort. The way you can get past it on the extended BI is, or after your 12 months, or actually after the building becomes tenantable, after you could get tenants back in there, it would be your extended BI. Normally it's 60 days. As I said, you can endorse on up to 365 days, and that would cover you until you get tenants back in there.
But in just the restoration, I go beyond 12 months.
Yeah, that's just it. If your policy is written on 12 months, an actual loss sustained, there's really, I don't know anything that changes that 12 months. Like I said, the only thing that gets past 12 months is if you have a manuscript policy from your individual carrier that gives you more than 12 months, or if you have that CP 0030 with a limit or an agreed value, then you can go past the 12 months. But other than that, the 12 months is a cutoff. Unless you're in California, they have a policy that extends it to 15, but if you're not in California, which I'm assuming you're not, other than that, it's 12 months. And yeah. And the only thing you can do is, try to cover that extended BI next time, whether they would we call it 323, but you can re-endorse things on whether they would do that now. I don't know, because I don't know who. But that's the only way you could do it in the future. All right. I have a few minutes yet, so I'm going to talk just a little bit about extra expense unless we have other questions. Okay. Extra expense. Again, sometimes there's not an understanding what extra expenses are. That's necessary expenses you incur during the period of restoration that you would not have incurred, would not have transpired had you had no direct physical loss. And the policies pretty much say that they have to avoid or minimize the suspension of the loss and continue operations, or just avoid or minimize the suspension of the business. There's no waiting period for extra expenses. So at the time of your direct physical loss on all ISO policies, your extra expense kicks in right away. You don't have to wait 72 hours, 24, whatever. It kicks in right away. But your extra expenses should be necessary. They should be extra, over and above normal. So lots of times an extra expense is going to be a temporary rent, rental of generators to dry out, outsourcing, things like that to get your products made, or a portion of your product finished or work on it. It could be extra, which is over and above normal. And the reason I say it has to be over and above normal, if you're going to use employees to make up time and you're going to pay them extra overtime, or they're going to incur overtime, which they never did, that would be an extra expense. So that's over and above normal. But it should also reduce the length of your period of restoration. So if they say your period of restoration should be 6 months, it should somehow reduce that 6 months, or it should reduce the dollar amount that would otherwise be payable. So lots of times what we do, or our adjusters ask us to do, measure like a 6-month total shutdown. What would be the loss for 6 months? Total shutdown. Then the business income loss that we actually measure and the extra expense you incur can't go over that threshold because you haven't reduced anything if it did. So that's kind of how we look at it. You can use it to reduce a business income loss dollar amount that would otherwise be payable. What's not an extra expense? Your normal payroll. As you recall, when we went back to the definition, net income and continuing expenses, including continuing payroll. Your continuing payroll is a normal operating expense factored in as continued on your business income loss. So normal payroll is not an extra expense. Only if you pay over and above what they would normally earn, which would be for overtime. If you decide to give them all bonuses because they've been through a stressful situation, we're sorry. That's not necessary. It might be very kind of you, but it's not necessary. We're also normal salaries that continue. Again, as I said, officers' salaries are key people. They're going to be paid under the business income. They're not an extra expense unless you pay them overtime on top of their salary, which they didn't incur before. And I have seen that maybe once in 32 years. Also, if you move into a temporary location, the temporary rent does not automatically become an extra expense, especially if you have a rent abatement on your lease. So if you were paying $2,000 on your lease, I don't know if these are the numbers I have, I'm just making these up, $2,000 on your lease, and now you're paying $2,500, $500 is an extra expense. $2,000 is your continuing rent, even though it's at a different location. If you were normally paying $2,500 and now you're paying $2,000, you have a non-continuing expense or a saved expense of $500 a month. So only an extra portion would be an extra expense. And what I normally say, look at your profit and loss statement, look at your tax return. Any expense that's listed on there is a normal operating expense. They're probably not going to be an extra expense because they're either going to be a normal continuing expense on your business income measurement, or they're going to be a non-continuing expense unless you incurred an extra portion for something. Then it may be considered an extra expense. But those normal expenses are normally not considered as part of an extra expense. And we see that all the time where claims come in. Every expense they continue to pay, they claim as extra. It's not. It's normal. We show you how you factored into their business income measurement, and then anything extra over and above would be the extra expense, not the normal operating expense. Any questions? I think I did pretty good, huh?
Is extra expense, is there usually a limit on the policy for that, or is it just, in other words, is it wide open? Is that if you can substantiate it?
On the CP 0030, it would pay you up to the limit on your policy with any co-insurance. Well, extra expense falls outside of co-insurance, but we would never go above the limit on your policy combined with business income on a CP 0030, because you've got a limit. If it's an agreed value, same thing. Monthly limit of indemnity, same thing. We're not going to go above your monthly limit, and it would be BI and extra expense combined in that payment.
So it's an extra coverage, not an extra limit.
It's not an extra limit. However, that's a good point. On the BP 0003, we'll pay actual loss sustained, but on the BP 0003, they're more in tune with it has to reduce your dollar amount of your loss, or it has to reduce the suspension of your loss. So if your extra expense doesn't do either one of those, then it's not always paid as an extra expense. You may think it's an extra expense, but it's not. But there's also a form called a CP 0050 that gives you just extra expense coverage, and you can have a limit on your extra expense in addition to your other coverage forms. So there is a form out there. Also, a lot of property extension endorsements, and I'm sure a lot of companies have them, give you extra limits for business income and extra expense, $25,000 here, $50,000 there, whatever. So there's a whole slew of those that I am not even mentioning, but they're out there. Okay. All right. Thank you very much. If you have any questions, please feel free to ask me.